For decades, Germany has been Europe's trusted backbone, the heart of the EU, and one of its largest economies. It became a manufacturing giant that produced world-class goods. But what once seemed like an unbreakable economic miracle is now starting to unravel. Germany's economy is expected to shrink for the second year in a row. Iconic German industries are struggling. For the first time in Volkswagen's 87-year history, the company is considering shutting down factories in Germany, a historic move. The country is likely entering its third consecutive recession, and more than 3 million people are currently unemployed. Yet Berlin is responding to this loss with a gamble, a €500 billion gamble. This is the largest spending package in the country's modern history, worth 15% of Germany's GDP. For a nation built on caution and fiscal discipline, never spending more than it earns and never borrowing more than it can repay, this marks a radical break. This principle sustained Germany for decades and shaped its reputation as Europe's economic anchor. But desperate times call for desperate measures. If this gamble works, it could revive not only the German economy but Europe as a whole. If it fails, it could destroy the reputation Germany spent decades building and potentially drag the entire European economy down with it. How did Germany get here? And can this €500 billion gamble really succeed? On the surface, Germany looks similar to other developed economies: an educated population, a strong middle class, and skilled workers. But at its core, it is fundamentally different. Most countries shift from producing physical goods, phones, cars, to services such as finance or legal consulting as they grow. But Germany is different. It still exports massive amounts of high-quality manufactured goods, mostly to other European nations. Take Wolfsburg in northern Germany. The city is home to the world's largest car factory, employing more than 60,000 people and producing nearly 1 million vehicles every year. This single factory produces more cars than the entire United Kingdom or Italy does in a year. Germany accounts for more than a quarter of all European manufacturing, and exports make up nearly half of its GDP, 3 times the share of the United States and far above France or the UK. This meant Germany constantly brought in far more money through exports than it spent on imports. The surplus flowed back into the country, providing companies with massive investment capital and giving the government extra tax revenue. As a result, the government rarely had to borrow heavily to keep the economic engine running. But this model came with a risk. If foreign countries stopped buying German products, the entire system would collapse. Germany was effectively relying on the goodwill of foreign consumers. Instead of reducing this risk, the German government doubled down. In 2009, it passed the debt brake, a constitutional amendment limiting annual government borrowing to 0.35% of GDP. For comparison, the United States regularly borrows more than 5% of GDP per year, more than 10 times what Germany allowed itself. The idea was that by committing to low borrowing forever, Germany could increase investor confidence and lower interest rates even further. And for a while, it worked. From 2010 to 2019, Germany's GDP grew nearly 25%, outperforming most of Europe. The economy seemed unshakable. Unemployment fell below 5%, and the country generated more than $200 billion in annual trade surpluses, more than any other nation on Earth. Germany became synonymous with reliability and precision, from its punctual trains to its famously engineered cars. Its economy felt like the backbone of the entire European project. It would take an unprecedented economic shock to knock Germany off course. Starting in 2020, that is exactly what happened. First came COVID-19. As countries entered months-long lockdowns, global trade collapsed. For any nation, this would cause problems, but for Germany, whose economy relied uniquely on exporting goods abroad, it was a disaster. Within months, German exports fell nearly 10%, wiping out more than $100 billion in trade revenue. The auto industry was hit particularly hard. Car production dropped by about a quarter in 2020, and global German car sales fell to levels not seen since the financial crisis. By the end of the year, Germany recorded its worst economic performance since World War II. Just as the country began to recover, a second crisis erupted: Russia's invasion of Ukraine. Overnight, about 20 billion euros worth of exports to Russia disappeared. On its own, this loss was manageable. Russia made up only 2% of German exports. But the real problem was Germany's dependence on Russian energy. Before the war, more than 55% of Germany's gas came from Russia. This fuel was vital for steel plants, chemical factories, and car manufacturing. Within weeks, Russian gas exports fell by 90%, and prices exploded. Electricity costs surged by nearly 35%. Factories began shutting down, not due to lack of demand, but because they couldn't afford to run their machines. Slowly but surely, Germany slid into recession. By the end of 2024, Germany's GDP had shrunk by more than $200 billion, enough to pay for 6 years of the country's entire healthcare budget. Germany has now been in recession for more than 2 years, nearly unheard of in the developed world. Normally, when wealthy countries face recession, governments spend heavily to support the economy, just as the United States did during COVID, spending over $5 trillion. The idea is simple: build roads, fund projects, pay salaries, inject money into the economy. People then spend that money, businesses grow, hire more workers, and production expands. But Germany couldn't do this. Its strict debt rules trapped the country in a downward spiral. Even with unemployment rising past 3 million for the first time in decades, the government was not allowed to borrow enough to stimulate the economy. Then things got worse. The US threatened to impose a 15% tariff on German imports. As America is Germany's third-largest trading partner, this would be devastating. Models predicted it would push the German economy even further down. At the same time, Donald Trump warned that NATO commitments would no longer be guaranteed unless Germany met the defense spending target of 5% of GDP, an impossible demand during an economic crisis. With its back against the wall, Germany finally did the unthinkable. In March 2025, the government suspended its sacred debt brake and announced a €500 billion spending package, the biggest in its history. The money is allocated to infrastructure upgrades, green energy projects through the Climate and Transformation Fund, support for struggling industries, and direct funding for state-level budgets. For a nation proud of its balanced budgets, this was not just another policy change. It was a last-ditch bet that Germany could transform itself fast enough to avoid collapse. In many ways, the strategy is logical. Models predict such a large injection could return GDP growth to positive territory within 2 years, potentially create more than 1 million jobs, and stabilize tax revenues. The idea is simple: spend big now on infrastructure, green energy, and industry to restart growth, then use higher future revenues to pay the debt back. Germany has one of the lowest debt-to-GDP ratios in the developed world, thanks to decades of fiscal discipline. So adding a few $100 billion shouldn't matter, right? For most economies, yes, and maybe for Germany too. But Germany faces a unique risk. The entire European economy depends on it as the lender of last resort. When countries like Italy, Spain, or Greece get into financial trouble, Germany has typically acted as the backstop, providing funds to stabilize their economies. Investors lend to weak European economies not because they trust Rome or Athens, but because they assume Berlin will step in if things go wrong. This system works only if Germany itself remains strong. But with the new €500 billion package raising concerns, investors are growing nervous. Reports indicate that foreign investors are already reducing their holdings of German bonds, and credit rating agencies are warning of possible downgrades. It is an extremely risky strategy, but Germany appears to have little choice. Without action, unemployment could rise above 5 million by 2026, and GDP could remain in negative territory. At that point, Germany would no longer be able to act as Europe's financial anchor. The new investment package aims to prevent that. It has 2 main components. 1. Infrastructure, roughly €300 billion. Germany will expand high-speed rail networks between major cities, aiming to improve transportation reliability and speed. Faster movement benefits passengers and creates efficient supply chains. For example, A car manufacturer in Munich could coordinate seamlessly with suppliers in Frankfurt or Hamburg, boosting productivity. Germany has historically underinvested in infrastructure compared to other advanced economies. As a result, cracks are showing. More than 36% of bridges on official routes need urgent repair, one of the highest rates in Europe. Only about 30% of the country has access to high-speed broadband, less than half the EU average. The country's infrastructure is in poor condition, and this plan could significantly address the issue. 2. Climate and Transformation Fund. Roughly 100 billion euros. This includes building massive offshore wind farms in the North Sea that could generate 6 terawatt-hours of clean electricity annually, enough to power 1.6 million homes. The government also plans major investments in solar energy, aiming to increase capacity fivefold by 2030. These initiatives are designed to reduce the impact of losing Russian energy. Despite improvements, electricity prices in Germany remain far higher than before the war. The idea is that if Germany boosts domestic clean energy, it can lower costs, support its manufacturing sector, and restart economic growth. There is historical precedent for such programs working. After World War II, Japan spent roughly a third of its budget on rebuilding roads, ports, and power plants. 2 years of nearly 9% growth turned a ruined nation into the world's second-largest economy. But Germany faces a very different reality. Japan was rebuilding from scratch. Every new factory or road produced huge gains. Germany, a highly developed nation, will see smaller returns. Instead of building from nothing, it is mostly upgrading existing infrastructure. Worse, the benefits of these projects will take years, even decades, to fully appear. Germany's own central bank predicts that these projects will not significantly boost economic growth until at least 2027. Meanwhile, the government must pay enormous interest on the borrowed money. Servicing the debt alone is expected to cost around 40 billion euros per year, about 8% of the federal budget, nearly equal to Germany's entire education spending. If markets doubt the investment will pay off, these costs will rise. A mere 2% increase in interest rates could add another 25 to 30 billion euros in annual costs. This is already happening. Long-term German bond yields have climbed to their highest levels in 40 years, around 3%. If they rise much further, the entire plan could collapse before it starts. Ultimately, the gamble comes down to timing. If the government completes projects on schedule, improves productivity, and calms the bond markets, Germany may escape recession. But if delays and cost overruns strike, a disaster looms. This moment is far more than a spending package. It's a complete rethink of how the German economy works. For decades, the model was simple. Keep public debt low, let the private sector drive growth, and rely on exports. This made Germany one of the world's richest nations, but also dangerously vulnerable to global shocks. Now Germany is flipping the model. Instead of being Europe's guardian of fiscal discipline, it is positioning itself as the engine of state-led investment, betting that hundreds of billions of euros in public spending can rebuild its economy from the ground up.
The result won't just shape Germany. It will serve as a test case for the entire developed world. Can large-scale government intervention reignite growth in advanced economies? Or will it prove that the era of state-driven miracles is over? No one knows. But what happens in Germany over the next decade will set the tone for economic policy across Europe and beyond.